Welcome to the Daily Update, where I'll go over the action in the market for Thursday, June 15th, and then we'll see how things look for Friday, June 16th. We're seeing kind of a runaway market right now. It's during times like that when we kind of have to be careful. It seems like everybody is afraid of being left behind. They're jumping in. They're throwing all caution to the wind. We're going up really far, really fast. We're very overbought and becoming even more overbought right now. So it should not be surprising if we see some kind of a pullback. Now, it is quadruple witching, and that will end on Friday. That's the last trading day. So this can really produce some jockeying around, especially if we have a really solid up week. We have to look forward to next week to see, okay, are some of those profits going to be locked in? We have some put options that are now out of the money, and we have some call options that are now in the money, and that can really change the overall dynamic of the market. Things are looking positive, though, overall, and it is nice that we're going up, but we want to look under the surface to see what is the foundation like as we've been going higher. Before I get started, please know that a little over a week ago, I posted a new supplemental video that talks about protection. Sometimes we call this hedging. It's more of a timeless video. You can watch it now, you can watch it later. It applies for all times, not just right now. I do have a PDF that you can download to follow along with the slides and charts. I also have a private Facebook group. I did post a new poll for this week, and I also post videos on Rumble in case you can't find me on YouTube. All right, let's go back and talk about what happened. Right at the open, it wasn't all that exciting. Things kind of developed as the day went on, but we did have a higher open. The futures were actually down a little bit, but then we ended up opening higher. Prices climbed to R1 at 43.96. As the day went on, we got up to R2 and we broke through 4,400. R2 was at 44.21 and we pretty much closed just a little bit above R2. We had come back down, but we closed near the highs for the day. We were up 1.22% on above average volume, so volume has been picking up. We are positive, but we're overextended to the upside, and this has to do more with the fallout of what the Fed did and what they said. It generated some positive backdrop, especially in the tech sector and a lot of stocks that have really been doing well. We're just seeing those continue to go up. But in Thursday's session, it was more broad-based. We're still really focusing on this inflation and interest rate scenario, and that's been in the background, and it will continue to be in the background for the foreseeable future. What are some comments that we can make? The S&P broke above and then closed above 4,400. Just a week or so ago, we were worried about 4,200. We bounced up to that 3 times, couldn't seem to break through it. Then last Friday, we got above 4,200. Then we eventually got above 4,300. And pow, here we are above 4,400. The higher move that we saw was broader based. We're seeing more participation. And we're still dealing with this idea of the fear of missing out, or FOMO. When we get close to that level, it can still play out for a while, but it also can mean some kind of a top or at least a pullback. On Thursday, the European Central Bank did announce a 25 basis point hike in their rates, and that was as expected. China announced a 10 basis point cut. They're having some problems economically in China right now, and their rate is now at 2.65%. China also reported some weaker than expected retail sales, as well as industrial production and fixed asset investment data. This reopening of China that was supposed to really help spark not only China, but the rest of the world, it's not really working out the way they thought it would. Be aware of small cap exuberance, and I have a chart later on to show you that, not so much in 2008, but when we were going through the whole dot-com boom and bust, we saw a real divergence between what the small caps were doing and what the large caps were doing. We're not really seeing that yet. We just want to be aware of that and watch for it. The ADX line with our trend indicator is extreme positive, and even our short-term indicator, the ADX, is now extreme positive. On a short-term basis, we have the short-term moving average study, the Stochk RSI, the Williams percent R, the CCI 14 and 20, our stochastics, our standard deviation, the CMB composite, the boom indicator, and the RSI based on 9 periods. This is all of our short-term indicators except one. The force index is still positive and not looking extreme. Intermediate term, the list is also growing. We have the McClellan oscillator based on the S&P 500, the Sean trend meter, which has been on there for a while, The Erin indicator, the PMO study, the percent B, the RSI 14. The boom indicator I've also added because not only in the short term is the 20 period looking extreme, now the 50 is starting to look extreme. The Connors RSI, we don't get many signals from that indicator. And then the BPI based on the NASDAQ 100 is starting to get extreme. The dollar was down and interest rates are also down, and both of these together help really give some support to stocks. We still have our yield curves that we follow that remain inverted. Sentiment is extreme positive. It didn't change, but we're still showing that we're pretty toppy as far as how people are feeling. Our trend, it's positive, and it is getting stronger. And the ADX is above its moving average, and both are above 20. The problem is the green line's way above 40, and as I said, our shorter term ADX that we're just starting to watch now, even the ADX itself is above 40. However, our bias and momentum still remain positive. We had a whole slug of economic reports that came out. One of the biggest ones was total retail sales. It was up 0.3% on a month-over-month basis where they expected it to be unchanged. When you take out autos, it was up 0.1% month-over-month as expected. The weekly jobless claims, they were unchanged, but they're still pretty high. They expected them to fall down to 251,000. They came in at 262,000. And continuing claims are at 1.775 million, and I have charts of both of these to show you. The Philadelphia Fed Index, it came in kind of weak, down 13.7. They expected it to be down 13. Last time it was down 10.4. But when you look over at New York, this was actually surprisingly better. It came in at 6.6. They expected it to be down 16. Last time it was down 31.8. Now we go through a whole slug of different information. Import prices were down 0.6% month over month. Last time they were up 0.3%. When you take out fuel, they were down 0.1% as they were last time. Export prices were down 1.9% month over month. Last time they were down 0.1%. Export prices, when you take out ag products, were down 1.8%. Last time they were down 0.1%. Total industrial production was down 0.2% month over month. They expected it to be up 0.1%. Last time it came in up 0.5%. Capacity utilization, it's under 80. That means we're showing some contraction. It came in at 79.6. They had expected it to be at 79.7. Last time it was at 79.8. Then the last one is business inventories. Up 0.2% as expected. Last time it was down 2%. Looking at some Isabel Net blog charts, this is showing global fund flows. It's kind of interesting. When you look at bonds plus cash, now that could be money markets too. It's really going up. That's the green line. And you have folks that are apprehensive about getting into stocks. Here's a chart from Carson. I hope you're able to see this little chart here, but it says 8 months without a new low. That's a good thing. And then it projects forward what are the returns 1 month, 3 months, 6 months, and 12 months out, to give you an idea that things still remain positive after we get this kind of a signal. Looking at the risky versus safe asset fund flows, we're still below the zero line, showing that folks are still favoring more of the safe assets. They don't really trust what's going on right now. That could give some support to the market. It's kind of a contrarian look at things. Then bonds only hedge stocks when inflation is at record lows. Of course, from about the mid-90s up until right before the COVID plunge, we were in a low inflationary environment, of course, with all that stimulus and fiscal policy and all that stuff that came flying into the U.S. economy. We've now switched over to a higher inflation environment, and so we're not seeing the protection that bonds are used to giving us. Now, this is a whole generation of people who are used to doing something a certain way. Now we're starting to see a shift in that long-term strategy that people used, and so they're experiencing some losses. Plus, 2022 was just horrible for bonds. It was bad for stocks. The only thing that was really up on the year was the dollar. Then we're looking at people that are overweight in investment-grade bonds. They're still not really willing to get into the high-yield bonds. Those would be junk bonds. Overall, they're still favoring the safer assets. Now, we're seeing some charts that we look at that's not really suggesting the same thing, but it's not as long-term as this chart. There's only 2% of investors that are expecting higher inflation. This could also be a contrarian indicator. People think inflation is going to go up and up and up. And so if it does start to fall, this is going to catch a lot of people off guard. And that could also give some support to the stock market. Then we're looking at the asset manager survey, and I go over this in the weekly video, where we're starting to get a little bit toppy here. It came in at 90.2 as the S&P has been going up. Usually when we get above about 80, that's when it starts to get extreme based on the chart that I show. Then we're looking at the debt allocation. It's at 21%, where people had been getting more into bonds, and now that's starting to roll over slightly. Then looking at the flow to know, is investors long investment grade bonds and their short stocks? Folks are trusting the bonds more because they think we're in a high inflationary environment, and so they buy a bond now, and then when that matures, they buy another bond at a higher interest rate. So it seems like that would make sense, and a lot of people are still getting into those bonds where they're pretty much flat when it comes to getting into stocks. Economic reports. Here's the weekly jobless claims. It did come in unchanged, but it's still rising. This is showing some initial weakness in the job market. Continuing claims also turning back up, but still below the moving average. Then looking at the three together, the red line are the initial claims where that spiked up and has stayed higher now for 2 weeks. The continuing claims are still coming down, but we're watching to see if that'll turn back up. And then last time we got the unemployment rate, which has ticked up to 3.7%. Looking at our charts, first the intraday chart, not really all that much, looked to be exciting right at the open. We just kind of went up a little bit and worked our way up to R1. It's like, okay, now maybe it'll start falling back down. No, we ended up breaking up to R2. We actually broke above that and then ended up closing down just above R2. So on an intraday basis, the futures were kind of flat overall, turned a little bit more negative in the pre-market session. Then we really spiked up during the day, and now we're kind of trailing off a little bit in the initial overnight session. Large cap growth and value kind of performing about the same now. We're seeing a little discrepancy here in some of our charts where it underperformed with growth when we look at large caps. It outperformed a little bit with mid caps and it underperformed with small caps. And I have a red box around here. Something's wrong with the quote that I'm getting on the small cap index, and it's showing that it was unchanged. Our Elders Impulse System chart hasn't updated correctly, and some of our studies might be a little out of whack until that data gets fixed. Then looking at growth versus value, this is another warning sign. As the market was just trudging higher in Thursday's session, the growth to value ratio was really going down. Looking at sentiment, still showing no fear. The VIX ticked up just a little bit. You have some folks that are wanting to hedge now. They know that we're getting a little toppy right here, and they want to lock in some of those profits. So we ticked up slightly with the line chart and a little bit with the bar chart. And the VIX of the VIX is also showing a slight increase in volatility of the VIX. We're still up in this red area for the skew index, and that may carry over into this quadruple witching options expiration. Maybe it'll settle down when we get into next week. Equity put call ratio actually ticked up a little bit, also suggesting that maybe folks are hedging ahead of the weekend, ahead of the options expiration. And we're also watching this longer term. This is still coming down. This is a 253 period simple moving average of the equity put call ratio. While this was going up, that was 2022. Now we're starting to roll over into 2023, and that could be positive longer term. Looking at the move index, where bonds were up, so the volatility of bonds did decrease. Even though stocks were up, the VIX did tick up slightly, and we're seeing their relationship start to go kind of in different directions. We look at the VIX to move ratio, it did spike up. That was mainly with the stock VIX going up more than the move index going down. So we'll just want to keep an eye on this. It's still suggesting that overall there's not a lot of fear. Looking at this fear gauge, we are continuing to drop off as we are with the other fear gauge. The posturing still remains heavily favored toward risk on. And then looking at our advanced decline line study, seeing some improvement here. We're breaking out based on price, and we're showing a lot more improvement based on volume. If we can stay at about this level, it would pretty much wipe out this negative divergence. Then this is also encouraging. We've seen 3 strong days with new highs really breaking out now, and that has really turned our 5 period up as well as our 10 period. So that's showing a little bit more internal strength. The advanced decline ratio is above 0 and advancing. That's positive. Accumulation distribution is also positive. We're seeing some improvement with the cumulative advanced decline line. It's really starting to break out. We're also seeing a breakout with the regular advanced decline line for the NYSE. We're also still above this trend line with the other NYSE advanced decline line that we look at. We are seeing some improvement with the common stock advanced decline line based on price and volume. We still want to see more follow through on this chart. Then looking at our broad range, the NYSE showing improvement, as is the S&P, the mid caps, and the small caps. Looking at our trend, this is where the ADX, the green line, is way above 40 now. It can still go higher than this, but we rarely see this strong of a reading. When we were really heading down, the red line got above 40 back in September of 2022. Now we're seeing the green line exploding to the top as well. Just to be aware of this, but the ADX continues to be positive. Here's our shorter term ADX, where the ADX itself is now above 40. Now, I use a little bit different settings on the ADX than other folks. They might use 25, they might go higher into the 45 or 50 range. This is what I found works well for the S&P 500 are the settings that I have now. But to see the green line and the ADX itself above 40 on a short-term basis is also suggesting that we're overextended. We could still keep going up from here, and this line could still keep going higher than it is, but at some point, we're likely to see things switch and at least take a rest. Looking at volume, it did pick up slightly, and it will probably continue to be solid on Friday because of options expiration. Our short-term analysis, where we're well above the August high now, and we just continue to go higher, we are seeing volume above average. On a short-term basis, the 20-period exponential is now getting extreme positive. We're still looking okay with the 50, and the 200 is also moving up. But when we look at the boom indicator, the 20-period, we're getting far away from that moving average, so this is looking extreme, and that's the short term. We're also starting to look extreme when we look at the 50. Now, this is a 50-period simple moving average, where the previous chart is an exponential moving average, a little bit of difference in how they're calculated. Longer term, we're still looking okay with the 200, but I have some longer term charts to show you later to see how are things going in the long term. So here is the 20-period simple and exponential moving average, and you can see we're getting way far away from that. The moving averages tend to act like a magnet, or price acts like a rubber band. We get too far away and it has a tendency to snap back because price is going up a lot faster than the moving average. This is still positive, and this could take a little bit of time to work out. We just want to be aware of this. Then looking at the CMB composite index, we're seeing a very high reading. Now, other times we had a high reading and the market kept going up. Other times here, high reading kept going up. This is why I use lots of different indicators. I don't just base everything on one. The Stochk RSI, you can't get any higher than the reading right now. The Women's percent R, you can get higher, but it's extreme positive. The CCI 14 is extreme, and the CCI 20 continues to be extreme. All of the different timeframes on this chart are suggesting that we are overextended to the upside in the short, intermediate, and long term. But our force index, it's not hitting the upper Keltner band right now. It's looking positive and it's going quite well, but we're not really hitting an extreme reading currently. Intermediate term, the balance of power, we're just underneath getting to an extreme positive reading. Connor's RSI, we don't see an awful lot of signals on this, but this is really starting to give an extreme positive reading. The go-no-go system remains positive. The TTM squeeze is positive. And then to give you some perspective, this is a longer-term look at the TTM squeeze. We still have some more room to go before we get extreme, but there's other times when we topped out at a level below this. This is another area in the short to intermediate term where we're really overextended. We're above the third standard deviation in this chart. Then the Bollinger Bands. We're above the upper Bollinger Band, which is measured by the percent B, starting to get extreme positive again. The Arun indicator is also giving us an extreme positive reading. The PPO studies on all time frames continue to be positive. The S&P McClellan oscillator starting to get extreme positive. It could go higher than this, but we just want to be aware of it when we get into this area. It's not an official overbought signal until it goes up and then comes back down and crosses below this line. Broader range, we're seeing some improvement with the NYSE McClellan oscillator, but it's not really breaking out. There is some improvement here, but we want to see this going up with the S&P itself. The summation index based on price showing some improvement, but is not broken above this trend line. We have been able to break out based on volume, so that is showing improvement. But when you look at the broader range, we are seeing some improvement, but the summation index for the NYSE based on price is still underperforming, looking a little bit better, but underperforming based on volume. Swenlin trading oscillator turning up based on price and volume and not giving us an extreme reading. The elder impulse system for the S&P is with a green bar. That's positive. We're still positive with the parabolic SAR. The PMO, that is starting to get extreme positive. We're still looking better based on price and volume. Then our PMO study, looking a little extreme with the PMOs that are rising, starting to get extreme with the buy signals, still looking positive with the PMOs that are above zero. The slope indicator, we're getting above this green line here, which means we are going up pretty far, pretty fast. This is our touchiest of all the oscillators that we follow. The MACD also looking good and might be getting ready to top out, but still could have some more room to run to the upside. All of our oscillators are now positive. The Sean trend meter ticked down slightly, but is still extreme positive. The BPI seeing a little bit of a breakout here. It's still lagging to a degree, but it is showing some improvement. The NYSE bullish percent index above 50 and advancing, but we want to see this really going higher to see real strength in the broader market. The broader market is improving, but there are still areas that continue to lag behind. The Chaikin money flow is positive. The Chaikin oscillator is positive. The money flow index is positive. The ultimate oscillator is positive. The vortex is positive. RSI 14 starting to get extreme. We've been extreme for a few days now based on 9 periods. On balance volume breaking out above the moving average. The Copic curve and the Pring bottom fisher continue to generate buy signals. We're seeing some improvement with our 200-day simple moving average study where we're breaking out. We're also seeing a bit of a breakout with the 50-period moving average study. There's another look at that same chart to give you some different color to look at if you find that's easier to understand. Fibonacci lines, had to take some of these off because we're breaking out above them. We're still above the 75% quadrant on this chart. Now we're starting to hit the underside of what could be some overhead resistance. We're back above the 61.8% retracement level on our longer term fib chart. And I'm not showing any of the other fib charts because the next level would be back to the all-time high. Our charts that we look at are all positive with the Heikin Ashi, the Kegi, the Renko, the 3-line break, and we had a new X drawn in with the point and figure chart. We're still working off of a double top breakout that was generated on May 18th. Looking at different indexes, we are seeing some improvement with the equal weight S&P, but it's still underperforming the regular S&P. This is also showing that same thing. A little bit of improvement where the equal weight is hanging in there, but the big boys are continuing to outperform. Still seeing this longer term negative divergence between the Dow and the transports, but we're seeing some strength in the transports right now, and that could really take care of this negative divergence if we continue to see more upside movement. We're still seeing a shorter term negative divergence when we add utilities. The transports, although they are improving, continue to underperform the Dow. Here's our discretionary equal weight, where it's been in a solid uptrend. Staples bounced up and are still in an uptrend too. When we compare the two and take a ratio, discretionary is outperforming the staples. The Dow is above this R1 level and continuing to advance, and it was one of the stronger indexes on Thursday. The diamonds have switched back to positive. The NASDAQ coming up to this R2 level continues to look really strong. At some point, we might hit some resistance. We're coming back to a previous high that was set in March of 2022. If we continue to go up, we'll see if that enters into the equation. And we're coming up to the 61.8% retracement level for the NASDAQ. But when you look internally, we're turning back up slightly with the new highs minus the new lows and calculated on a cumulative basis, but it's still going down overall. On the bottom, this is more positive, where the highs minus the lows continue to be above zero. The NASDAQ 100 also breaking out above this R1 level, could have some resistance at this R2 level if we keep going up. We're also coming right up to that late March high in 2022. Can we break through that? So far, we hit that level and came down slightly. Then when we look at the Qs for the elder impulse system, it remains positive. And then looking at the BPI for the NASDAQ 100, we're starting to get extreme positive again here. The ratios from the Qs to the diamonds is showing that the Qs are really outperforming. The small cap index, and this is where we had some erroneous data. We were up 0.89% and still above this R2 level, even though we're in an overall downtrend. The small cap index, we're still below this resistance level. It had been support, but as we've been coming back up, it's now acting as resistance. The RSI turned back up slightly and the MACD remains positive. The small caps, though, continue to underperform the S&P. Here's one of the longer term charts. This is just something to keep tucked in the back of your mind. When we look at late 1998 into 1999 and 2000, the dot-com boom and bust, where we started to top out with the S&P and go down, the small caps were continuing to go higher. Okay, just something to watch for. We're not seeing that now, but we're waiting to see, is something like that going to happen? Where the S&P's been doing really well, the small caps have been lagging. That's more of a negative divergence. When we hit problems in 2007 into 2008, we didn't see that, where the S&P and the small caps kind of went more in line with each other. I was watching the Final Bar video put out by StockCharts.com, and they pointed this out in the video. So it's just something we want to watch. Then looking at small cap growth versus value, it did tick up and is still in an overall uptrend. The mid caps breaking out and staying above this R2 level. And the mid caps remain neutral for the Elder's Impulse system. But when we look at growth versus value, growth is really outperforming. The FANG index continues to go up and up. We're wondering, can we come back to this previous high set at about the 8,000 level? ARC continues to look a little bit better and a recent golden cross. The robotics and AI ETF continue to do well by itself, but it's not really outperforming when you compare it to the tech sector. The broad range of stocks continue to really outperform the bond ratio, and another broad market looking at a further out bond ETF continues to show stocks are outperforming. The tech sector is really outperforming bonds. Keeping an eye on the financial sector. We were up over 1%, but we're still in a downtrend. And then longer term, we're going back to 2007, which had been a high. And then back in 2020, it became resistance. Well, we were able to break through that in 2021. As we're coming back down, it is now acting potentially as support. Will that level hold? Now, we're still 25, 30 points away from that, but we just want to be aware of this. However, the financials continue to underperform the S&P. And the regional banking ETF is doing a little bit better, but still underperforming the financial sector. Keeping an eye on bonds, where we saw yields dropping and prices going up, we bounced off of this 200-day moving average. The longer-term correlation is showing a little bit of improvement, but to see it even drop below zero at all is kind of strange. The shorter-term relationship is showing some improvement, but the spread between the two is really wide. This could be a real shifting longer-term relationship that's going on here, where we're seeing the S&P really going up and bonds not really performing as they had in a lower inflationary environment. Then when we look at the S&P and compare it to bonds, it's still suggesting that they are anticipating a soft landing. Here's an inverse of that same chart, again, just showing how bonds are underperforming. Then we look at the value to growth ratio and show that it's going pretty much hand in hand with the 10-year Treasury yield. Riskier bonds are still being favored over more conservative bonds. Shorter-term bonds, meaning cash, are still giving us a little bit of concern here, where we had been going down with this overall ratio. Now it's starting to go back up, even though it came down slightly on Thursday. Looking at shorter-term bonds with longer-term bonds, we're up at the upper end of this rainbow. In a more positive environment, we want to see this continue to drop. And here's an inverse of that same thing. In a more positive and sure environment, we want to see this ratio going up. We're also keeping an eye on the 3-month yield and comparing it to where it was back in 2007. We're above that and coming back down. The bigger picture behind this is this giving us some kind of a warning sign? Long term, and I have a few extra charts, we're looking better with the special K. We're breaking out above the red line. Our moving average study, we're getting a little toppy with the 50. I just use that for reference, but we're looking better with the 150 and the 200 and not extreme. Also have a rate of change chart going back 200 periods. Now looking at this chart, you might conclude, oh my gosh, we're getting extreme in the longer term, but the next chart is the same thing, just showing that we've been at this level before, but we still have more room to run to the upside. Also, an update of our trend channel. I usually go over this over the weekend. We're above the midpoint of the trend channel and showing some improvement. An update of our possible positive scenarios. We're starting to get a little toppy based on volume. We're still looking okay based on price when we look at the 19-day exponential moving average of the advanced decline ratio. The Qs continue to outperform the S&P. Discretionary was down a little bit, but is still strong overall. and large cap growth is outperforming large cap value. Our growth to value ratios, large caps doing well, seeing some improvement with the mid caps, and we're pretty much flat with the small caps. Looking at the stocks above their 200-day simple moving average inside the S&P, we're above 50 and advancing. We want to see this continue to go up, which would suggest more broad participation. The S&P continues to outperform utilities, so this ratio is still looking positive. And our broader range of the 5-period moving average of the highs minus the lows continue to be positive. The 10-day average of the highs and lows just in the S&P, we're starting to get kind of an extreme reading. But if we really continue to go higher, we can camp up here for a while. That would suggest good solid momentum. Right now, we're just kind of coming in where we hadn't been there in a few days. Then looking at the longer term, new highs, new lows, a 50-period exponential moving average, we're going back positive, and our indicator is showing a lot of improvement. Here's another warning sign. When we look at S&P growth versus value, it's starting to underperform even though it's in an overall uptrend. But this is more positive. The Staples to S&P 500 ratio continues to fall. I always like to point this out. When this spiked and started coming down, this was after the S&P had already had a good run up. Well, after that, we chopped sideways, but now we're starting to break out. So what's our outlook for Friday? It is quadruple witching. Be aware of that. A lot of craziness can happen because of the day. We do have the Bank of Japan that will be meeting on Friday, and then the Bank of England will be meeting next week to discuss their interest rates. Our technicals are positive, but we are overbought. Some of the negatives that we've been following, we want to keep an eye on those, but they are showing some improvement. We have consumer sentiment coming out on Friday. And then the list of geopolitical events with inflation and interest rates being the real focus. We're coming up to Friday of this week, and our economic calendar is almost completed. We have a Fed speech that will be given in the morning on Friday, where Governor Waller will be speaking in Norway. Then looking at the Stock Traders Almanac for June 16th, we're positive with the Dow, and we're neutral to positive with the S&P and the NASDAQ. We're on the 12th trading day of the month, and in a pre-election year, the green dash line is still showing some strength. If you're into the NASDAQ, you still have a ways to go before we get to the middle part of July. Historically, that has been a strong period. Our scenarios can't go with the down one now. We're just really looking strong here, but we are overbought. We'll have to see. If we do hit some kind of resistance, especially like with that NASDAQ 100 going back to the previous high and then falling back, if that bleeds over into the rest of the market, we'll be evaluating things to see, are we just pulling back or are we going to shift? So we're still going positive overall, but we are quite overextended right now. We're not going with the sideways trend because both of our ADX charts are still strong. So our warning signs, the BPIs in the broader range are still diverging, but we're seeing a lot of improvement in the S&P 500 BPI, but we still would like to see more strength from that. A lot of these negative things that I've been trying to point out and signs of weakness are showing some improvement, but they're still there. The VIX is showing that there's no fear. The cumulative new highs, new lows showing a little bit of improvement, trying to turn up, but are still showing weakness overall. The 3-month yield, even though it's dropping, is still above the pre-Great Financial Crisis level. Small caps generated a recent death cross, but have seen some recent strength. And then we're kind of still dealing with earnings season. Positive signs. We have these seasonality and setup charts that I don't talk about that much. I might go over them in the weekly video, or I might bring them up from time to time in the daily video, but those are still in the background and they are still positive. The new highs, new lows for the S&P, that is quite positive, and we've seen a real shift there. The long-term special K, it's going above that red line and looking more positive. The equity put call ratio, when you go back 253 periods, it's still continuing to fall. That could be positive. The Copic curve and the Pring bottom fisher are still generating buy signals. We're still above that downtrend channel upper line. I didn't show that chart because we're getting so far away from it now, but I'll keep an eye on it. And if we start to fall, we'll be looking at that chart again. We're still in a risk on posture. Lower price levels may provide some kind of support if we start to fall. The S&P is outperforming utilities. The NASDAQ just continues to go to the moon. And staples are underperforming the S&P, which can give some good support to the S&P. The mid-caps generated a recent golden cross. And then finally, small and mid-cap growth is still showing strength overall. We're a little bit concerned about what we're seeing with the S&P growth versus value, but this area is still looking fairly strong. So our conclusion, the S&P, it's positive, but it's overbought. Short-term and intermediate term, not in the long term. It's going to take quite a bit more for that to happen. The negatives and divergences that we have been seeing, they're still there, but they are improving. In the short term, we're positive but overbought, as well as the intermediate term, we're still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day on Friday, and I will talk to you in the next video.